Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. We have two offices, one in Cary, North Carolina, as well as one in Southern Pines, North Carolina. Obviously, in today's virtual world, we serve clients all over the country. Today, we're going to talk about the update on inflation that was published yesterday. We're going to talk a little bit about what that means for Social Security benefits starting in January. A reminder about MediCare Open Enrollment. We'll update some stats on the 60/40 portfolio and talk about the massive rally that we witnessed yesterday, Thursday the 13th of October. And then we're going to question whether or not we're going to return to the pre-pandemic levels. So let's dive in. So yesterday, the 13th of October, the government updated the official consumer price index, and that's on the screen now, and you can see that there's really no change in the statistic. We're still at about 8.2% on the official stat. That is, again, the highest that we have seen in about 40 years. This morning, the 14th of October, we got an update on the retail sales statistics. I don't have an updated chart on that one, but it appears that that statistic is flat, meaning no change, neither positive nor negative. However, the data suggests that consumers are spending the same amount of money, they're just getting less goods and services for that, which is what we would expect to see. So again, not good news, but if you are on Social Security, there is an update there as well. This was published earlier this week. This is from Reuters, but you can see here that in January, if you are on Social Security, you're collecting Social Security, your benefits will rise about 8.7%, again, starting in January, and that is the highest hike since 1981. So starting on October 15th, Medicare's annual open enrollment period will begin. And President Biden recently announced a reduction in Medicare premiums. However, that doesn't mean your overall costs for Medicare are going to go down. It is still entirely possible that your costs will go up. So this is the time of the year where if you're on Medicare, you might want to consider reviewing the coverage and the plan that you have to determine if you want to make any changes. In particular, again, you have the choices of using the original Medicare plan, a supplemental plan. This is when you can choose the Part D prescription plan, as well as Medicare Advantage plans. If you need help in any of those efforts, please let us know and we can refer you to a specialist in that regard. Finally, we're going to wrap up by talking about the overall markets. And in particular, we're going to start by looking at this classic 60/40 portfolio. We've talked about this multiple times throughout the year. This classic 60/40 portfolio is what we sometimes refer to as a lazy portfolio, where you put 60% of your portfolio in equities and 40% of your portfolio in fixed income. And in particular, this is a article from Reuters that discusses that the 60/40 portfolio is facing its worst return in about 100 years. Again, no surprise to those of you who've been watching this channel for a while. This has been a very difficult year. So let's talk a little bit about the big picture and the massive rally that we saw on Thursday, the 13th of October. So this is a quick look at the overall span on the left-hand side. This is the pre-pandemic highs. This slight gray bar is the recession, the COVID recession, if you will. So this is the pre-pandemic highs. We're going to come back to that in a minute. I've labeled the chart with the highs of August 31st of 2020, as well as October 12th. Those are some peaks that are important. Now, if we zoom in on the right-hand side, you'll see this massive candle that we witnessed yesterday in the overall market. And this is us zooming in. So this is yesterday, October 13th. What we're trying to highlight here, this is Wednesday. So we had a gap down. The market opened at this level down here. That's a gap down of almost 2%. The market traded down briefly, and then it went on this massive rally where by the end of the day, bottom to the close was about almost 5.5% rally. Now, when we look at things like that, we like to look at some statistics. And yesterday, this is according to Sentiment Trader, they're on Twitter at the handle that you see. Yesterday was the 5th largest intraday reversal. Again, reversal means that it started trading down and it reversed higher. That's what a reversal means. So yesterday was the 5th largest intraday reversal from a low in the history of the S&P 500 and the 4th largest in the history of the NASDAQ composite. So that means the bear market is over, right? Hardly. So now we want to look at a couple of things from history to kind of put this in perspective, because we're in a very volatile time period right now. And so we're trying to keep all of this in perspective. So what you see on the screen, this is 2006, and then we've switched into 2007 right in this area. And so the market had a really tough day towards the end of February. The market rallied off of that. And now this is in July of 2007. You can see a correction of at least 10%, especially if you include this lower wick on this particular very, very volatile day. Now then the market rallied, and we're up here. The highs looks like October of 2007. Fast forward the videotape. Now what I want to show you, this is 2008. And in March of 2008, we see this massive rally. Again, a candle of about a 4.5% day, almost 4.25% perhaps. That is March 17th, 2008. So that candle looks pretty similar to the candle that we saw yesterday on October 13th. Well, what happened after that? So this is that rally that I just showed you, the 4.5% or 4.25% rally, and the market was recovering. Again, this is 2008. So the market rallies and it continues to rally. So overall, there's about a 12% rally off of that, what was then the low, this low of approximately a 20% decline. So what happens next? The market fell another 50%. Okay, so just because we see a rally like we saw yesterday, while that's certainly good news, that doesn't necessarily tell us anything. That doesn't give us the confidence to say the bear market is over and let's go whole hog again. That's not true at all. In fact, one of the concerns that we have is whether or not we're going to return to the pre-pandemic levels. Again, if you look at the charts, we started this year off in a correction. We got these little rallies. All right, so we've been in this correction, and one of the things that we've been talking about is whether or not we be retesting these levels or this level from June. We obviously did that. We retested, we rallied off of that to start the month. It was a very good start to the month of October, and then the market came right back down and retested that low. And with Thursday's report, we gapped down again, which is the level that we talked about. We might be testing the August and October 2021 highs. Well, that happened, and we have this massive reversal. Well, the concern that we have is, are we going to retest this green line, which is the pre-pandemic highs? Now, why do we say that? Well, if we start looking at the various sectors of the S&P 500, you'll understand. So now on the screen, I've got 4 different sectors. These are 4 sectors of the S&P 500. So this is the material sector, and you can see this is the pre-pandemic high over here, and this sector, which is a component, this is a part. All of these are parts of the S&P 500. The market has come down. This sector has come down, but has not retested the pre-pandemic highs. Well, this is XLC. This is the communication sector. Again, here's your pre-pandemic highs, and we've actually already gone below that. So this is a sector in the S&P 500 that's already below the pre-pandemic highs. And over here we have XLF. XLF is the financial sector. Again, here's the pre-pandemic highs. And again, it has already tested and at the moment has rallied back above the pre-pandemic highs. Here's the industrial sector. All right, so again, same thing. It has already tested the pre-pandemic highs. Now let's look at the next 4 sections of the S&P 500. This is the tech sector, XLK, pre-pandemic high level here, and you can see that this sector has indeed come down, but has not yet tested that pre-pandemic high. Consumer staples, same thing. You're getting really close to testing that pre-pandemic high. This is the healthcare sector down in the bottom left. That would have to correct about 16% in order to test that pre-pandemic high. But look at consumer discretionary on the bottom right. this has tested the pre-pandemic high. So there's a lot of these sectors of the S&P 500 that have already tested the pre-pandemic levels. So again, top left, real estate is already below the pre-pandemic levels. Utilities already below the pre-pandemic levels. This one in the bottom left is energy. We've talked about that a lot. This has not been testing this. This has been arguably the strongest sector for the year. Now this bottom right-hand corner, this is commodities. This is technically not a sector of the S&P 500, but this is also something that we have been discussing, is that sector has also been pretty strong this year. So this one has not tested the pre-pandemic highs. So you can see that there's so many sectors that have retested the pre-pandemic highs that we are on alert, if you will, that the overall market, we would not be surprised if the overall market also tested the pre-pandemic highs. Anyway, that's enough for today. I'll wrap here. Thank you for watching. If you haven't already, please make sure you subscribe to our channel. If you have any questions, please by all means reach out to me or my team. We'd be happy to see if we can help you. Again, thanks for watching. See you next week.